Good afternoon, everybody, and welcome to Credit Chat. I'm Rod Griffin, Director of Consumer Education and Awareness for Experian. And it's been a while since I've been on the road and had some technical issues, and finally am back and here to answer your questions about credit reporting and credit scoring and fraud and ID theft, all of those things that are so important. This time of year, spring's coming around. Miss ZD4, good to see you again. Thanks for hanging in there. A little late. Couldn't get logged in for some reason today. It's been the last couple of weeks have been a challenge, but we're here now and ready to answer your questions. Please ask if you have concerns or thoughts or issues that you need to understand better. That's what this is all about, is really helping to help everybody get a better understanding of how to use your credit history, your credit scores as a financial tool. You want to take the mystery away from those things. There shouldn't be. You should be able to walk into a lender, know exactly what you're going to expect, what they'll see, and be able to get the credit you need when you need it, be able to protect yourself from fraud and ID theft, know what to do if you're a victim, all those kinds of things that affect us all, and me included. I have a credit report, I have some of the same issues that everybody else does. So we're kind of all in it together. I want to make sure that everything we're doing at Experian is helping people connect with better, healthier financial lives and resources and tools. So that's what it's all about. So please feel free to ask any questions you have. A lot of stuff going on, of course, in the financial world. March is almost here. That's Credit Education Month, so you'll be hearing more from us then. So looking forward to that. And I don't know if that's an L or an I, Ashadi 77. My score went up, but no place but Experian. Why does Boost not show up anywhere else? So good point, and something to discuss. Experian Boost is a free resource, a free tool that lets you give us permission to capture your on-time cell phone payments, utility payments, things like cable television payments from the bank account that you pay it through. Add that as positive information to your credit report, just like an account. So once a month, we would capture that payment and add it to your report, to your credit history. We can go back up to 24 months. That's only an Experian service. So the information does not get included in our competitors' credit reports. And so that's why you're only seeing an increase in your Experian, the scores calculated using your Experian report. So if a lender gets your Experian report and they use a score that information feeds into, it will include it, help improve your credit score. So FICO 8, FICO 9, and so on, and FICO 10, I'm sure, but I'm not seeing that used yet. So we've probably heard about FICO 10 lately, their newest score. That's going to be rolling out soon. And then that's up to the lender as well. If the lender is using other scores, and often if they get 3 scores, they'll take the middle score. So that may be the issue, but in a lot of instances, it will help, and it will help build that history over time and help you qualify for other kinds of tools, resources, if you're applying for other kinds of loans. So it just depends on the lender, but it is a benefit to your Experian history, not yet included in the other 2. So working toward that end, I think you'll see more of what we think of as alternative data, I think, in reports in the future. And I hope that it's in what we're doing with Experian is empowering people to have control. And I think we're going to see more of that over the coming years. So kind of the first step. And so it's something we're still growing, learning from, and appreciate your feedback. It's really important to hear. And I do share that, by the way, with our executives and with our leadership. So, and our product development people and others. So they do hear about it. Aquanet, thanks for joining. I don't know if that's a throwback to the old hairspray, but I've never used it, but I think my mom and my grandma did. Hudson 495, thanks for being here. Again, if you're just joining, I'm Rod Griffin. I'm Director of Consumer Education and Advocacy at Experian. This is Credit Chat. I try to be here 1:30 Central, 2:30 Eastern on Tuesdays and Thursdays. The last couple of weeks have been a bit of a challenge. Last week I was in our Costa Mesa facilities, and for security reasons, it turns out they blocked my phone from doing live video, so I couldn't get online. This week I had some issues on Tuesday, couldn't get things to cooperate. I was flying last Thursday, so I'm glad to be back. Sister Beauty, thanks for joining and being here. Thanks for the hearts. Please don't be shy about asking questions about your credit report, your credit history. It's, I think, really important to share. I know that if you have a question, others have the same question. And want to help you get the answers you need. Tina LaRoe. Tina LaRoe is actually Christina Roman, who is now on my team as of last Monday. So Christina's now helping support our education and advocacy programs. I'm really excited to have her as part of the team. She actually is coming back to Experian. She worked as one of our social media managers a few years ago, and then for some reason left the company. But I'm very fortunate to have her back and be on my team. She's extremely passionate, extremely intelligent and capable. So really excited to have her here, and being part of the team. You'll probably see more of her as we in the future, I hope. Joe Cool 33, thanks for joining. The only thing I would ask is she not ask me too many hard questions. And do her best to make me look good, because I can look bad all by myself. No, but thanks for joining, being part of the chat, and please do ask any questions. I know it's hard to get started sometimes, but when with all of the things that happen, all the things we're hearing about, again, we're hearing more about the FICO 10 score and trended data. Really interesting. I'm going out back to Costa Mesa in a couple of weeks. We're going to meet with our consumer council. So we work with a number of advocacy and financial education organizations to advise us on issues and to help us better create products and services that will help people have access to a better, financially healthier life, and have tools that can help them improve their financial standing and achieve financial inclusion, which are huge issues, particularly for people who are what we think of as emerging consumers, and beginning to build their credit history for the first time. So excited to meet with our council and the advocacy community as always in a couple of weeks. So looking forward to that. Planet 62, my credit card will cancel in 60 days because I don't use it. Good or bad idea? So here's the answer to every question you can ask, and I kind of tongue in cheek, but true at the same time. It depends, and it depends on your particular need, right? So I've had lenders do the same thing. I've had credit cards that I just don't use, and so I get a notice that says, because you're not using the card, we're going to cancel it. And the reason they do that is because they have to meet all of the legal requirements around reporting and updating and managing those debts. So it's a cost to them. And if you're not using their account, it's just an expense and it's not benefiting you because you're not using it. So you might choose to. I would look at several things before you decide to do that. If you're going to potentially use the card because you need it for something in the future, maybe getting points or rewards, and you want to keep that open, and not a bad idea, go make a charge so it's active and they keep it open. If you're planning to make a purchase in the next 3 to 6 months with credit, like a new car, new house, something like that, particularly a major credit purchase, it's probably best to have them keep it open until you complete that process, because when they close that card, what will happen is your utilization rate will increase. So your utilization rate is your balance to limit ratio on your overall, all of your cards together. So when you lose the available limit on that card, your balances as compared to your available limits on the remaining cards goes up. That usually causes scores to drop for a period, not generally a lot, but it could be enough that it could interfere if you're in the process of applying for a major credit application. So usually best to leave that until you complete that process, and then you can say, don't want it anymore, go ahead and close it. There are lots of reasons that you might close it. One, you don't use it. Two, if you're not using it and the card's sitting around, the account's open, it could create an opportunity for fraud. For example, it could lose the card, somebody could steal it, or there could be a breach in access an account, things like that. So you might want to close it for those reasons if you don't use it, especially if you have other accounts that are open and active and in good condition. So there are reasons to close it. I've done it. I've had cards where they've said they're going to close it. I've let that happen. I have others where, I might use it and have some things going on, so I'll go ahead and make a charge and keep it open. And that's all it took in my case. And usually that's the what I see is that if you want to keep it open, go make a small charge, $10 or $20, and pay it off right away. Don't carry a debt, but then you keep that card open. I have $75,000 of credit, no debt. Just don't use this one. Yeah. So if you don't use it, your credit scores are really strong. Probably not a big issue. Again, if you're going through something like buying a house, that can take several months, and drops and changes in scores could affect that process and slow it down. So you might want to wait. But otherwise, you have to look at your overall financial situation. What I often tell people is don't let a credit score be the only factor in making a financial decision, and don't let a credit score cause you to make a poor financial decision. It's one of the things to consider, but there are lots of other things too. So, it's an important factor, but it's not the only one. And so you need to do what's right for you and your financial situation as a whole. Scores are one of the things to consider, but also, what's the temptation to use a card? People may have an open account, they're struggling with some finances and could get deeper in debt. So it might be good to close the account so they remove that temptation. So lots of reasons that people can have. Might want to keep it open because you're planning to take a vacation in the next year and maybe start using that card to take on points. So lots of reasons that to do either, and good ones all the way around. Michelle, thanks for joining. I'm trying to scroll back and make sure I didn't miss anything. Anybody's questions? Use it, pay it off at the end of the month, and then it's open and active. You don't lose the account. So it just depends. Scores usually rebound. I think I said, after 2 or 3 months, if it becomes clear that you didn't take on debt. So your utilization change isn't the result of taking on debt. It's just that you closed an account or had an account closed. And so they'll typically recover. And that's why you should make sure, if you're planning to do something in the next 3 to 6 months, that maybe you leave it open. Otherwise, we'll probably be fine, assuming everything else is in good shape. Or they charge $95 a year. Yeah, so if they're charging an annual fee and you don't use the card, another good reason to close it. So very good point there. In some cases, an annual fee for a card can pay for itself. If you're actually using the card, getting the benefits from it, and it pays for that fee, can be a great tool. So you always look at exactly what you need it for, how you're using it. If a miles card, use it, pay it every month. Yeah, and so you're collecting miles, you're getting a benefit, and it makes sense to have that card open. So, different ways to approach it. And so, like I said, it depends. And it always depends on your particular unique situation. I always tell people there are 220 million people, actually more than that, with credit reports. And every single one of them is different. And their financial situations are different. And their particular financial needs are different. So they have to make a decision based on that overall picture. A bank offered you $10,000 to use $4,000 in 3 months. Does this make sense? Michelle, so I've seen those cards, and there's a well-known blogger, calls himself the Points Guy. Like, he can learn a lot about what that requires. There are cards and how he uses them. He's pretty brilliant, but he manages way better than I ever could. So I don't do that because I would mess it up. And he manages lots of cards. But the point being, he'll mention, and I've seen cards and had seen offers where you'll get a really good offer, but in order to take advantage of airline miles or the points or the benefits that are offered, you have to charge a certain amount within a given period of time in order to trigger that reward. So if it's worth doing that for you, it might make sense. I've seen, for example, airline miles where you have to charge a certain dollar amount within a certain period in order to get X miles. And if a person's traveling a lot for business, or they're traveling for pleasure, or whatever the case may be, if they're flying a lot, they're making those charges, might make sense. If you're not, maybe not. So it's always that trade-off. What is the right thing for you? But yeah, I've seen that. It's pretty legitimate. Some people will use a credit card to pay all of their daily bills, groceries, gas, maybe even house payment if they're allowed to do that, and then turn around and pay it in full right away. So they're not carrying debt, but they can capture those miles and meet those requirements. If you can manage that, not a bad strategy for some people. For others, it gets really complicated. You have to track it, and you could find yourself in debt. So again, you have to know yourself in a lot of ways and how you would manage credit. But it can work. In the process of restoring your credit, should I pay the highest creditor first or the lowest? And that's always a huge debate, right? And there are different ways to approach it. There's the snowball approach, there's the avalanche approach, what they call, the different names for them. But what the math will say is that you should pay off the account with the highest interest rate first. that doesn't always work for people from an emotional, human sort of approach. So, I always tell people, in my perspective anyway, is math never lies, but it doesn't always tell the whole story either. So, if paying the highest interest rate means that you keep paying as much as you can, but you're not seeing the balance come down very quickly, it can get frustrating. You can feel defeated and give up. And we don't want that to happen. So that may not be the best approach for you. If you're paying off the lowest balance first, but you're able to do that, see the progress, it keeps you motivated, and you can take what you paid there and roll it into that higher interest card, and you are able to continue to do that, maybe a better approach. So math will always say highest interest rate. Emotion and our human nature might say take a different approach. You have to do what's right for you. And so my position is do what works for you. I don't care which one it is. So be sure that you do something that you can stay motivated with and that helps you achieve that goal. So take the approach that works for you. Don't always look at what the recommendations are for from some of the experts who will show the math, which math's always right, except that it doesn't always consider life and our human condition. So, always looking at that when you're going to buy a home. So yeah, so if you're going to buy a house, and it really depends. The key is reducing your overall credit balances, your utilization rate, and making sure your payments are all on time. So if you do what works for you, and you may want to extend that time frame, you might want to wait a bit. Get a copy of your credit report, get a credit score, get the risk factors that go with it, because the risk factors are the statements that tell you what from your credit report most affected that score. And if it says your balances on your credit cards are too high, pick a card, start paying it off, and look at what works for you. If you can make larger payments and pay that higher balance or the higher interest rate first, great. If not, and you can make a higher payment and have a bigger impact over a shorter time on that balance for a card with a lower balance or a lower interest rate, fantastic. Do what works for you and helps you get to that financial goal. But know where you're starting first. So get that report, get the score, get the risk factors, and that will arm you with the information you need to move forward in improving that credit history and those credit scores if you need to. Ali Fabiano, thanks for joining and being part of the chat today. Jay Romeo, thanks for being here. If you have a question, please feel free to ask. I'm Rod Griffin. I'm Director of Consumer Education and Advocacy for Experian. This is Credit Chat. I try to be here every Tuesday and Thursday. Been having lots of issues the last couple of weeks, but finally made it back. So I'm glad to be here and have all of you talking to us. So it's always great to have the questions. Do you conduct online classes that people can attend? Me, Moshel. I don't, but I love that idea. I'm not sure if I can, oddly enough. There are issues and challenges with that. I think it's a fantastic idea, something I'd like to explore. Time and resources and business liabilities, all those sorts of things come into the question, but would love to. Right now, this is as close as I get, so I'll try to do this as much as I can, but I think I love that idea. And maybe it's something we can explore. I'll talk to my team. I'll talk to Christina, who's been here back with me a week. So, and I told her we get lots of ideas and things we might pursue. So lots of work to do there. So, but I love that idea and would love to see if we could do that. Mel Jess, thanks for joining. And yeah, Christina is get to work on that real quick. See how we can do that. This is honestly one of the best parts of my job, because I love to have that engagement and share information that I know is helping answer the questions you have and get to hear from you. And it tells me what we need to know and what we need to work on and what information you need. People have been watching the Periscope for a while have heard me say that, I've been with Experian now almost 23 years. And when you're in the corporate world, they teach you to do death by PowerPoint. I'm very adept at that, but I would rather not. Because I could talk at you for hours about what I think you should know and not answer the questions you need. So that's what I love about this platform, is lets us answer the questions you have and specifically need to have answers to achieve your financial goals. So I love doing this. The credit score game is nerve-wracking. Score dropped 15 points for a $23 increase in the bill. I'll be there if you do. I'll keep working on it, Michelle. So your scores will change as your balances go up. Just to give you a sense, my scores over the holidays between November and January dropped 40 points because I usually don't use a credit card much, but when I was traveling, I use a card because it's safer and easier to manage and than carrying cash and those things. So visiting family and doing some things, shopping for the holidays. So my balances changed and my scores dropped. And by the way, the higher scores are, the more they will drop. Don't be too alarmed. After January, so into February, my scores have gone back up almost 30 points. So paid off those bills, back to where we normally are, and they start rebounding. So I can tell you from personal experience, I know exactly what you think. At first, some of these gray hairs I used to get from worrying about that, I've kind of stopped doing that because I understand you'll see that fluctuation, and you just have to give it time, and they'll go back up. And that's why I say if you're planning to make a major credit purchase, it's best to be consistent, stable, and until you complete that, and then you'll see that rebound. So yeah, I know what you're saying. I did the same thing. I looked at my scores right after the holidays and went, oh my goodness, and looked at it again. I try not to do that more than about once a month because of the cycles, because you can watch that score and it will go like this, but hopefully trend upward. You'll never see a smooth curve or a straight line. It just doesn't happen. It's kind of like the stock market, but usually without the huge jumps. So yeah, I know what you're saying. Don't panic. You increased a balance, it dropped right away. It'll probably be back up. I'd guess if you pay that off and your balances come down a bit, you'll see it come back up again fairly quickly. And the other thing that I would mention is make sure you're looking at the same scores consistently. Now, I've talked to people who have gotten access to one score, looked at it, went the next month or the next week, got a score from somewhere else, and it was lower, and it's just because it's a different score. So make sure you so that you can comparing apples to apples, right? So it's really important to do that because I've seen people do that and they panic, and then you find out, oh, it's just a different score, and you go back and the other score's the same or better. So be sure to look at the same score. Be sure to look at the same scores from the same sources. $30,000 limit usage, 10%. The lower the better. You're in good shape. I suspect your scores are really high too. So if you have really high scores, a 20 or 30 point drop may not really mean anything in terms of your ability to qualify for the best terms and best rates. To always try to look at that too. Don't look at just the point change, but what does it really mean in terms of risk, in terms of where you are do you have really good scores that show you're a good risk, you'll still qualify, or does it show that you've dropped in tier, that sort of thing. So make sure, kind of understand what the meaning of that point change is, because it can look huge, but in terms of your ability to get credit that you need at the best terms and rates might not mean anything from a scoring standpoint. If your scores are 750 and above, and generally you're going to qualify for the best terms and best rates. So fluctuations at the high end usually don't really have much meaning in terms of ability to qualify. It's kind of can freak you out because they go up and down. I understand that, but in terms of real impact on your ability to get credit, think about that too, and it can kind of calm you down a bit. Max Racer 777, thanks for joining us. Remo Ventura, thanks for joining and being part of the chat. Please feel free to ask any questions you have. I was getting started, so I'll hang on a little bit longer. Teach people to balance transfer 0% interest. J. Romeo. So yeah, use the tools that are available to you to manage your credit, to manage your debts, to manage your credit history, and always, I think education and knowledge is power. So if you have a card, you're trying to pay it down, and you have a high interest rate, you can transfer that balance and get a lower interest rate, which can lower your payments, and then keep making that bigger payment. Your balances will come down, and that's the trick. If you transfer a balance, it means you need to not use the old card anymore, because that temptation can get you in trouble. Now you have one with zero balance, and you can make charges, and now you're compounding the problem, and you want to make sure you don't do that. So be careful about doing that. Women in Purpose, thanks for joining. My students are asking questions. What's considered a good score at 19? Again, it depends. I've seen 19-year-olds with scores above 700. We just did a survey not too long ago and looked at generations. And so 19-year-olds, Gen Z, my camera pointed the wrong way. Don't know why I did that. But when you looked at Gen Z, their scores are lower than other generations. So a bit lower than millennials, lower than Gen X, lower than baby boomers, but moving in the right direction. And so, your scores probably at 19 aren't going to be tremendous. If you have one at all, in order to have a credit score, you have to have a credit history. So you have to have an account in your name or be an authorized user or have a cosigner in order to have a credit report, which could then be scored. So you may not have a score at all. So make sure you have a credit history or a credit account so that it can be scored. Then it's an issue of how long is that history. Scores typically require 3 to 6 months of credit history for an account before it can be included in a calculation. Vantage Score in some cases can calculate a score after a month of having an account open. Probably won't be very good score, but if you have a history and you're developing it in time, those scores are going to get better. So don't expect a great score right out of the gate, but give it time. If you have an account with a small credit limit, for example, or a secured account with maybe even just like a $500 limit, but you make a $10 or $20 purchase each month, pay it in full, so there's activity. You can start to build that score over time. I've known 22, 23, 24-year-olds with superb scores because they manage the credit they have well. It's not about how many accounts you have. It's not about how much credit you have. It's about how you manage the credit you do have available to you, which is kind of a subtle difference, but you don't have to have a lot of accounts. You don't have to have huge credit limits. It's about using what you have available well and doing that consistently. And time is a huge factor. So as you go through life, the scores will typically improve. But at 19, you're just getting started. I know it's hard to be patient. Believe it or not, I still remember when I was 19 and you want everything right away and you want it to get there fast, but it just takes time. And with patience and consistency, you'll get there. Credit is kind of boring to do it well. It means you just you're consistent in making payments. You're consistent keeping your balances low. Very little excitement is a good thing in credit. You're doing the right things the right way consistently, and your scores will improve. So time is an important factor. 720 score can't get better rate unless you have collateral to borrow against. America's fixed trap. I'm not sure I understand the last part, but if you're at a 720, that's considered prime, but low prime, so low to mid prime, and get your credit report, get those scores, get the factors. Look at the factors. It will tell you what you need to work on. Take advantage of Experian Boost if you haven't done that, and give that a try against permission-based. It's free, and we're seeing people with thin files and scores of 680 or lower see score increases of about 19 points on average, but people with other histories, when they add Boost, on average about 13 points for 2 out of 3 people. That might give you that boost to move forward. So possibility there. And you just keep focusing on those issues that are identified by the risk factors. That's going to be key, and doing it over time. Now, what are some websites or links we can go onto about building credit? So me, Michelle, you can go to Experian.com/consumer education and find lots of good information. Experian.com/consumer education resources. It will have brochures and PowerPoints and things. That's the site our education team maintains, self-educators and others. You'll find brochures you can download for free, PowerPoint presentations with talk notes. There's actually a very simple, basic lesson plan around credit. There's a game I call it Credit Jeopardy, but kind of modeled on that idea. And so tie that to our presentations, and you can play a game. We used it actually with students. I've used it with executives at banks. So kind of fun. But Experian.com, and go to the advice section. The other great place. My team writes something called Ask Experian in the Q&A. So we answer people's questions, often from our Periscope questions that you have if we don't get to them. We'll include them in our Ask Experian posts. And there's lots of other advice there in the Ask Experian section. So several places you can go. And that's kind of the key. Just keep doing what you're doing. And then recovering. And it is tough and it's hard. And when things are difficult, been there too. When I was in my mid-20s, I did the pay one credit card off with another thing and got into trouble and honestly borrowed from my family to get out of it, my grandma to get out of it, and then paid her off and never did that again. Worst feeling in the world was borrowing from my grandma. So never want to have that feeling again. So how does Boost work? So J. Romeo, with Boost, go to Experian.com/Boost and you can learn about the service. What it does is you give us permission to access your checking account or savings account that you use to pay your utility bills or your cell phone bills through, and we're able to capture that payment. We're not capturing the whole bank account. We're not leaving that. We're capturing the payment. So if you pay, XYZ electricity company, you'll tell us that's the payment. So we look for that each month in your statement, grab that payment, put it in your report as an account. So it's like a payment every month for that particular account. We can do that with your cell phone bills, with your cable television bills, with your water, electricity, utility bills, if you're paying them through what we call a demand deposit account, which is a checking account, savings account. And it's with your permission. So if you decide you don't want us to, we'll stop. You just tell us to stop and we will. It's a free service. But we give you a free FICO 8 score at the start. We give you another FICO 8 score when you've enrolled. And as you go through the process initially, if we are trying to find that account, we find others that would qualify, we will let you know, and you can tell us, yes, I want to include them, or no, I don't, and help you through that enrollment process. We'll go back up to 24 months in payment, so you automatically can get 2 years of payment history for those accounts. And it's the positive information. In the past, you didn't get credit for paying your cell phone bills on time, utility bills on time. If you didn't pay them, the collection accounts could potentially show up in your credit report, and you would get negatively affected by them, but you wouldn't get the positive benefit of paying them on time. And we have researched that. We have something called our data labs that studied this for years and found that people who are paying their cell phone bills or utility bills on time, who otherwise may have very little credit history, that's a good sign that they would be a good credit risk, and they just don't have the traditional history to qualify them for lower cost accounts, traditional banking relationships. And so using something like Boost can give them access to lower cost credit, better financial services, help them break cycles of predatory lending and those sorts of things. So that's what we looked at, and that's the underlying element of Boost, is how do we help people who should get credit but who don't have the traditional kinds of accounts that let them do that, gain that access. So that's kind of what that's about, and that's how it works. Pretty straightforward. If a credit card shows on my credit score, okay. If a credit card on your credit score, it's not reporting. So the challenge is with credit reporting in the U.S., it's voluntary. Lenders do not have to report to us. They choose to. They may choose to report to one or two, but not all three of the national credit reporting companies. So Experian, TransUnion, Equifax. So it's their decision. So you can talk to your lender, ask them. I always recommend that if you're going to apply for an account, you ask the lender, will it be reported to at least one of the national credit reporting companies, and so that it will help your credit history. But that would be my guess. Now, the other thing you might look at, if it's a retail account, sometimes you will see the name of the retail store, but that won't appear on your report. And instead, it would be the name of the bank that actually manages or owns that account, and they're just a branding relationship. So look for that. I hear that come up once in a while. May not be your case, but I hear that from people sometimes. They're just looking for the wrong name. So if you flip your card over usually and you read that little fine print at the bottom, it will say such and such bank, and look for that on your report. That's probably where you would see it if that's what's happening. So like I say, don't know if that's your situation, but I've had people ask that, so share that too. Ask me before. What did they ask me before? I missed something. Credit card shows a score, but I said no, but would love to. So if they have, maybe it's the class thing. We need to work on that. Best steps to get approved for a mortgage. Get pre-qualified. or pre-approved, and that way you'll know where you stand in terms of what you can qualify for, and you'll be able to look for homes in that price range. And that helps because you don't want to look for a mansion where you can afford, only afford a smaller house, and it can be disappointing. But set your expectations, and from there, standard things. Get your credit report, know what your scores are, and work to improve those scores. Use the factors. I say that over and over and over, but that's when you get the risk factors, they'll tell you exactly what from your report you need to work on over time. Work on those, and mortgage lenders for the best terms and best rates typically want to see scores in the mid 700 range. Doesn't mean you can't qualify, but you may need to pay down points. You may need to, points being interest rate, so you put extra money down and you can get a lower interest rate. So you might want to save more. When my wife and I bought our house 20 years ago now, we both worked weekend jobs. So we put aside savings and we started thinking about not just how we qualify for that loan, but also how do we maintain the house after we have it. So the water heater goes out, or we have a leaky faucet, or we have a window break. What do we do to maintain this? What are we going to have to do to make sure we have some savings set aside? So we actually saved almost 2 years before we started to apply, and lived in a little 1-bedroom apartment, and I worked for Experian. So, and I'm not embarrassed about that at all. I was making a good living, but I wanted more set aside. So think about those kinds of things so you're prepared not only to buy the house, but once you're there and in it, that you're able to maintain it. And if something goes wrong, you're able to cover that expense. So it's that emergency savings and the savings set aside. Don't get, my personal experience, don't get in a hurry, but make sure you get those scores where they need to be, and some savings set aside, get pre-qualified, so that you know where you stand and what range to look in. And that way you're better prepared to go through that process. And then be stable. So when you start to apply, don't change things in your credit report. So don't apply for new accounts. Don't go buy the furniture on a credit account until you have the house and then have to store it somewhere, because that could affect your scores. So make sure you have the keys in your hand and you moved in, and then start making those kinds of changes. Stability is a helpful thing. Jay Romy, I'm sure you got it now. The key is keeping it. Yeah. Someone was asking we talked about how Boost works. How do I boost my score when I have huge balances that I can't pay off quickly? Weber fan, and patience. I mean, and there is no quick fix. Always caution when someone says do this and you can have great scores tomorrow. Be careful about that advice, because I've not ever seen that work. Scores and credit history have to change over time. So some of it's patience. Just start to pay them down. Pick an account. Start to pay it off. Put as much as you can toward that one account while you still pay the minimums on others. As the balances come down, your scores will start to come up. And there isn't a really quick answer. Sometimes it's just a little at a time. So don't have a really, there's no quick fix. And so there's no silver bullet. Time is a huge factor in scores. Kind of talked a bit about mortgages. Not too trusting of banks. Do I need to show balances in my account in order to get a mortgage? Michelle, maybe. That's really kind of a lender question. They'll look at your credit history, your credit scores, to see that you use credit well. They'll Fannie Mae and Freddie Mac, who are the government-sponsored entities, GSEs, that underwrite mortgage lending, set kind of that number for mortgage lenders. It's typically now 720, 750 for the top or lowest rates, the best rates, but doesn't mean you can't qualify. So look at that. From a mortgage lender's perspective, they'll tell you what their criteria are, what kind of bank information they need. Do they need to see savings? How much down payment? Those sorts of things based on your income, your other assets. They're going to look at those things. They're not part of a credit report. So they look at your overall financial picture, and savings is one of those things. Can you weather a financial downturn, right? Or some difficulty, and continue to pay them on time. Always important. Do you have a cosigner? So, someone else joining with you, and what's their credit history and their financial situation look like? So they're going to look at all of those things when you go to buy a house. Mortgage scores are around 50 points lower than regular scores. Never had one. Yeah. And there are mortgage scores. And the other issue is in the mortgage industry, they're typically still using FICO 2, which is a 15 or 18-year-old model. There's been some shifts recently in Fannie and Freddie who show that they may do something, they may allow other scores. So that could change in the future, which I think would be a good thing. I think because the market's changed, because consumer behavior changed, because the economy is different, allowing newer scores that better predict consumer risk would allow more people to qualify who should be able to qualify but can't with the current system. So something to look at, and the GSEs that I know are considering it. There's been some movement there. So important to see those changes. But yes, scores can be lower because of the models they use. And so what we call models, the formulas, the scoring systems that they use. Is it negative if I open more cards with higher amounts and ask for credit increases just to increase scores? So Revelation Ruth, that's it. I saw somebody flash by my window, walk by my window. So that's a great question. And when you hear that, when you're talking about utilization rate. So if I ask for a credit limit increase, will that reduce my utilization rate? If it's approved, yes. If you open new accounts, could that potentially, if you have low balances or no balances, reduce your utilization rate? Yes. But anytime you make changes in your credit report, it's not just one thing. So if you ask for a credit limit increase, your balance is presumably already high compared to your limits. The lender might treat that as an application for new credit, and so could post what we call hard inquiry, record you've applied for new credit. That could offset that benefit. The change in your account because there's been a change in your credit limit may initially cause scores to dip a bit, or cause that change to not result in improvement. If you're applying for new accounts, you have hard inquiries, then you have new accounts that it's not clear yet how you will use them. You're going to take on more balances. Is that going to get you deeper into debt? All those questions start arising, and so your scores as a result could go down instead of improve. So it's never just that one thing. If you have high balances compared to your credit limits, the best thing to do, instead of trying to, for lack of a better phrase, game the system, the best thing to do is pay down those balances. You'll see a faster, larger, lasting improvement in your scores, and you'll reduce your financial stress because you'll have less debt and benefit overall. So, trying to manipulate scores, when I've talked to people who've done that, tends to backfire, and they don't realize all of the implications, and it can differ depending on your credit history. Low balance is trying to get to 800. So look at your credit risk factors that you get with your score. If it says your balances to limits are too high, pay down the balances. You may not have to pay very much down. So the higher your scores are, the more impact that even a small balance can have on them. So paying down those balances could result in a bigger increase. If it doesn't say balances to limits are too high or utilization rates too high, that kind of language, that's not the issue to work on. So look at those risk factors. That will tell you what you need to work on. It might say there are no issues. Time is the factor. So keep doing what you're doing. So it's always better if you can to reduce your balances. That will always help. But time could be the issue. But look at those things. Make sure you're not doing something because you've heard it somewhere else and it's not specific to you. I'm always careful about that too. Everybody's different. And there's no universal advice except keep your balances as low as you can and pay your bills on time. Those two apply to everybody. But when you start looking at, what do I do for my specific situation? Got to look at the risk factors and go from there. Does rental data affect FICO 8? Yes. So it would include your positive rent payments. At Experian, you can actually have your positive rent payments reported as well. If you talk to your landlord, they can report it to us. So if they agree to. So talk to your landlord. It's a 1 unit in a house or it's a 10,000 unit complex. They can have your positive rent payments reported. And we've seen that people who do that actually almost 100% of the time see improvement in their scores or become scoreable if they didn't have a history initially. So really powerful. Rental and utility both affect FICO 8, but not 4. They may affect FICO 4, not sure. In some of the mortgage models, they don't feed in. So it just depends on the history. But the newer models, FICO 8, FICO 9, VantageScore 3.0, 4.0, and FICO 8 is now the most widely used FICO score on the market. VantageScore 3.0, 4.0 are strong competitors, so kind of like Ford and Chevrolet. So those two are the most commonly used right now. So would likely improve and be beneficial to those in most cases. The effects of a hard inquiry fade after a few months, even though it stays on report for 2 years. New York Zeppelin, yes. And that's one of the things people worry about inquiries. I never really worry about inquiries unless you're applying for a lot of stuff all at once, a lot of accounts, which is not a good idea. And it would really be more that you have all of these new accounts. That's the issue, not the inquiries. But if you apply for something, you have a hard inquiry, those inquiries are the least important factor in credit scores. And they may have a few point impact, but within usually a couple of months, a couple of billing cycles, so 2 or 3 months, the new account will appear in your report, and that offsets that inquiry, so it doesn't really mean anything in terms of risk. FICO scores exclude them completely after 12 months, so and usually they're just a few points. So yeah, inquiries are the last thing to worry about. Put it this way, an inquiry by itself will never be the reason you get declined. There will always be something more important. So hugely important. And with that, thanks for all for joining. Stayed on a little bit longer because I joined a bit late, but Warren Rubin, thanks for joining. Just as I'm signing off, I'm Rod Griffin, Director of Consumer Education Advocacy for Experian. This is Credit Chat. I try to be here Tuesdays and Thursdays, 1:30 Central, 2:30 Eastern, to answer your questions about credit reporting, credit scoring, fraud and ID theft, all of those things that can affect us and your credit history and help you be more financially healthy. So thank you all for joining. Check us out on Twitter on Wednesdays. Join our Credit Chat on Twitter, 2 o'clock Central, 3 Eastern. You can learn more. We're going to talk about money in a relationship next week, so that should be fun if I'm looking at the right date. But join us on Wednesdays, 2 Central, 3 Eastern. You can learn more about this Periscope and our Credit Chats at ex.pn/creditchat. And don't have any classes yet. Somebody asked that earlier. We're going to have to look into that. But thank you all so much for being here. Hope to see you all again soon. Take care, everyone.